Okay, welcome everyone to Investing for Generational Wealth. Let's dive into the world of expert financial insights and strategies, and we have a good one today. But before we begin, quick disclaimer as always, we're not financial advisors. All investments are subject to risk, including possible loss of the money you invest. So perform your due diligence before making any financial decisions, and of course, consult your CPA and your attorney before making any investments. I'm your host today, John Lai. I'm joined by my co-host, Keshav Kolur. And welcome to today's episode. It'll be a good one. Why should I invest outside of the stock market? You've heard us talking about real estate a lot. We're going to talk about real estate and a couple other opportunities, or not opportunities, but asset classes that you can invest in. But today's guest, Keshav, you know him. He's the principal and founder of Clive Capital, private equity firm specializing in delivering exceptional risk-adjusted returns throughout investments in real estate, energy, private debt, and more. And you'll hear some of that today. He's a seasoned software engineer, worked for top-tier companies like Amazon, and of course, Facebook, where he's at now. Keshav's journey from entrepreneurship is really fueled by, and we'll get into this today, greater investment diversity. So without much ado, Keshav, do you want to talk a little bit more about your background?
I think, yeah, actually, I guess, we can get started that way. So, hey, everyone. Yeah, former Amazonian here. I would say, as far as my background goes, just the whole reason for today's talk and kind of what we do at Clive Capital. Personally, growing up, saw my parents commuting an hour and a half each day to work for decades as we were growing up. And then saw what the stock market was doing to their savings day in and day out. Remember the Dow being at like 9,000 points or something back during the 2008 crisis, maybe even lower. I remember this one analyst, Betty, on Bloomberg. She would always come on and talk about stocks and stuff. Betty Lou, maybe someone else. But I just didn't want that to be my life. I am grateful for what my parents have done because either they're first generation or I'm first generation. I forget. I grew up here, but they grew up in India and moved here. And they did the best that they could, but it's my job as the next generation to do better. And I don't want to commute an hour and a half a day, every day to work, be at the mercy of someone else, when layoffs come around. And so I was looking around and saying, hey, everyone else is in the stock market. There has to be a better way than just 10%, average returns, no tax benefits, the volatility. And that's really what prompted me to start Clive Capital. So I guess go back a little. Started out as a realtor in Detroit at my first job out of college in 2019. And sold a few homes, realized that I didn't want to buy single family homes, that syndications is a better way to go. Whether you're active or passive, I would rather invest into multi-million-dollar, tens of millions, hundreds of millions of dollars in assets with other investors rather than do it myself. But no one else I knew was doing it. And so I actually took a year from September of 2020 to September of 2021 to do my due diligence, because I thought that what I was hearing, 20, 25, 30+% returns per year conservatively and passively was too good to be true. If this is so good, why isn't everyone doing it? Why are so many people in the stock market just content with 10%? So took a year to do due diligence, read up on books, watch YouTube tutorials, network a lot, invested into my first syndication at 108 apartments in San Antonio in September of 2021, started seeing the tax benefits coming in, filed a Schedule K-1 tax form, started seeing the cash flow coming in. And at that point, I realized, okay, I filed my taxes and I'm still making money. I haven't been audited yet, so I must be good. And we are good. Syndications are a great way. And since then, in January of 2022, started my company, Clive Capital, where John helps me, and our goal is to help primarily tech professionals, but other high earners do three things primarily: achieve higher risk-adjusted returns, meaning higher returns, but not at the chance of taking on an infinite more amount of risk. Otherwise, we would all just go play the lottery. Two, better passive income / cash flow. That's what's going to help us retire and give us freedom back in our life. And three, tax benefits. As high earners, we fork over probably north of 25% of our income every year to the government. And it's one of our biggest obstacles to building wealth. So if we can passively and legally reduce those taxes, then we should. And with that goal in mind, we've helped investors invest into over 900 apartments under renovation so far, 500 single-family homes under construction, and I myself have personally invested into oil and gas for the first time, where I've bought land in Wyoming as part of a syndication with other investors. It actually just paid out its first distribution a few weeks ago, but that is probably something that we'll also bring to our investors in the name of tax benefits, returns, and diversification.
Yeah, I can't wait for that, as you know. I need those tax deductions. As much as real estate is great, oil and gas seems like it's so much better, but we can talk about that in a little bit. It's the stock market. So people have invested in the stock market for forever, right? Whenever the stock market was created. And yet, and it's had its bull run. It's starting to kind of do a horizontal sideways movement. What don't you like about the stock market? And I can talk a little bit about my experience growing up, watching my parents invest, and then going through, if you're old enough to have gone through this, the 80s, where the stock market just crashed. And, they lost probably good 70% of the investments that they had accumulated throughout the 5-10 years that they invested. So it was pretty amazing, and amazingly in a bad way. But people have seen a good bull run in the last, call it 10-15 years. So what about the stock market? What's your perspective?
Yeah, TLDR, not a fan, for a bunch of reasons. One, I would like to do better than 10% a year. And I think that's totally possible without taking on superior risk, which we can cover. Two, there's not that many tax benefits, right? You have your short-term capital gains, which I guess there's minimal tax benefits there. You have long-term capital gains, and you have qualified dividends, I believe. We can do better. And that's what we'll talk about, right? That's the second thing I don't like. Third is a lack of diversification. Right now, a lot of the stock market returns, I believe, are heavily weighted towards the tech sector. Like the Magnificent Seven contribute for a large amount of the US market cap. And they're all in the technology sector. And if you really have your eye on diversification, that is something that should make you a little uneasy, at least. And man, there's so many things. What else? Volatility, right? A war starts halfway across the world. We have 2 wars going on right now. Your returns are affected in ways you could possibly not even conceive. A rocket gets launched over there, stock market's down here because of fear in the market. In addition to that, I would say lack of transparency. Most people are probably investing in index funds that are tracking the S&P 500 or something else. S&P 500 tracks the 500 largest companies by market cap in the US stock market. No one on this call knows how those companies operate, what their financials are like, what their forecasts are like. We can look at Wall Street analyst expectations and EPS and things like that. But I would bet anyone to tell me with a straight face that they understand how Meta makes its income. Like thoroughly, or be able to quantify its downside. How far do you see Meta stock dropping, right? Or Amazon, right? And then extrapolate that out to 500 companies in the S&P 500. So there's lack of transparency there, where it's just impossible for anyone to get a handle on how each business is doing, right? What else? I also don't think it's a level playing field. The SEC obviously persecutes people who do insider trading and things like that. There's a reason there's a website out there tracking politician trades in real time. There's a reason hedge funds exist. They have, cable or wiring that literally lets them make microsecond decisions on algorithmic trading. That's not the kind of competition that I want. Those are just a bunch of the reasons. I'm sure there's one or two that I can't think of, but those are some of the primary reasons that I am not a fan of the stock market.
So given all that, why does it make sense to invest in these alternative assets? And maybe you can define what we mean by alternative assets.
Yeah. I'll start the answer off by saying it's my personal opinion that I don't like the stock market and I don't want almost any of my portfolio in it. If I can get out of it 100%, I would. That doesn't mean you have to hold the same opinion, but I do think diversification outside of it is worth it. And that's why everyone's here, to learn about that. So for definition, alternative assets is just anything outside public markets, right? It's not your stocks, your bonds, your index funds, your ETFs. These are private investment opportunities that are not available on the stock market. Examples are if you just go out and buy a house and rent it out yourself, that's an alternative investment in my eyes. If you invest in a syndication where you pool money with other investors to go and buy apartment buildings, that is an investment, alternative investment. Or if you pool money and you go lend it out to home flippers, right? That's an alternative investment. So I'd say anything that's not your stocks, mutual funds, ETFs, bonds, things like that. The reason that I like alternative assets, right, the ones we focus on primarily is built-to-rent construction, single-family home construction from the ground up, multifamily value add, where we are renovating hundreds of apartment units and then selling them to the next group, and energy, like I mentioned, the oil and gas investment I made, and private lending money out to people with some sort of collateral, buying businesses. All of these things are interesting to me and something that I see as a part of Clive Capital's portfolio going forward. All the reasons that I don't like the stock market are reasons that I like alternative assets. Projected returns are higher, right? We will typically aim for 20, 25, 30% returns per year, conservatively. Now, those are just projections, and I'm legally obligated to tell you that they are just that, projections. No investments are guaranteed. There's always risks in investing, blah, 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 blah. But that's what we project. And obviously, we wouldn't be taking the trouble of investing outside the stock market if our returns weren't better. 2, the tax benefits are better. Again, not a CPA, but just from my experience, the tax benefits are better. And if I can find a way to passively and legally pay fewer taxes, I will. And I have more visibility into my investments, right? I can't call up Zuckerberg or Bezos and say, hey, why are my shares down 20%? None of us on the call have the authority to do that, unless there's a VP.
You probably could, you wouldn't get through.
Yeah. But in alternative assets, typically you're investing in a group of 50, 100, 200 investors. You are more than just the name on a piece of paper. You're a face. You are an investor in a private opportunity with only a handful of other people. You have access to the financials of your investment, of the performance of the people running your investment. So you can call up the CEO, the principal of the investment, and say, hey, why are my returns missing projections? Besides that, we can take into account insider trading. Like, we can take advantage of that in private assets. If I hear, for example, that there's a big Walmart coming nearby, I can rush and go and buy the land surrounding that Walmart to put up single-family residential home rentals. I can take advantage of that knowledge. Not something you can do on the stock market. The passive income is better, the cash flow. Alternative assets typically cash flow a lot better than the 3 to 4% or 5% dividends you get in the stock market. And a big thing that I like is lower volatility. These investments are illiquid. You cannot sell them at the drop of a hat with a monkey brain like people do on the stock market. If things go down, people sell on the stock market. And if, you know, and there's no diligence or patience that investors practice because you can hit that buy sell button. And alternative assets, because it's illiquid, it's very difficult to sell out of your investment. It teaches investors patience. It also teaches them due diligence, that if you're going to lock up hundreds of thousands of dollars, you better know what you're investing into, and you better be sure that you've mitigated your risk. And what that does is, because alternative assets require a higher level of experience, investors are more disciplined. No one's going to hit buy and sell, out of panic, causing the price to go like this. So some of the reasons I like alternative assets.
So some people might think of that, the illiquidity, as a downside of alternative assets, right? Investing in alternative assets. I like that perspective of not being able to do so, and that being reflective in the lack of volatility. I don't think, I mean, yes, you make money on volatility, but there are winners and there are losers, and we don't want to be on the losing side for the most part. So
Yeah.
I like that perspective. What are other potential downsides of investing in alternative assets?
Yeah, it's a great question. It is not all peaches and roses. I'm not here to tell you that. That would just be unrealistic, and I would be lying to you. When you're investing in alternative assets, most of them are typically still monitored by the SEC, Securities Exchange Commissions, because at the end of the day, you are still investing into securities, aka investments. It might not be the stock market, but it's still investments. So you can mitigate, there's some mitigation there, right? Make sure you have the right SEC, security on your legal documents. I would say too, the most important thing when you're investing outside the stock market is who you're investing with. Most people are not interested in picking up a second job to invest. They just want to know that their investments are earning them a solid rate of return, and that they can sleep at night knowing that their principal is protected. So if most people don't want to pick up a second job, then they're going to invest with someone whose primary job it is to invest. And at that point, your investments are at the mercy of that person that you're investing with. So your due diligence must be heavily focused on that person. If that person, we'll call them a fund manager, for the sake of this conversation, they're managing your funds, right? If that person can find the best of the best investment opportunities, even if it's during times like 2008 or the 1980s or the dot-com bubble, then they're a good person to invest with. On the other hand, if you're investing with someone who doesn't know what they're doing, they could totally screw up and even lose you your investment during 2020, when nearly everything was on a bull run because of the record low interest rates. And there's a lot of questions that you should be asking this person when you're vetting them to make sure they're the right person you should be investing with. Like, hey, what is your track record, right? How many years have you been doing this for? Tell me about a time when one of your investments went south, and how did you communicate to your investors about it? What did you do? Was it just hush hush, radio silence, or were you transparent and upfront about the bad news? And like, what is your investment thesis? Why do you like this investment? Why do you not like this investment? Like, I was able to tell you all, hopefully articulately, why I don't like the stock market and why I do like real estate and oil and gas and private debt. And John and I have worked together on a more comprehensive due diligence checklist, which, towards the end of the webinar, we'll throw a link in here. But that checklist is 50 to 100 questions about the questions you should be asking the person you're investing with, regardless of what you're investing in. Real estate, be it energy, be it a laundromat, be it a startup company, all these questions will apply. So your due diligence is definitely necessary on the person you invest with. But once you find the right person, it's most of the work is on them, and you should be able to rest easy.
Yeah, I think I would definitely second that opinion, which is the bulk of your work really should be vetting the sponsor or the person you're investing with, the fund manager, right? Like once you've vetted them, hopefully they will prove out their performance for you and you will see your returns. Once you've done that and they are able to offer you additional opportunities, then you don't have to vet anyone else. Now, as a good investor, you should definitely diversify, which means also diversifying across fund managers. But the hard part really is vetting your fund manager or your sponsor to make sure that they are who they say they are, they have the experience, and they will prove out and return the projections that they're projecting, or hopefully beating the projections. So that's great. So why haven't I heard of these? So for myself, I went into the job market, started investing in stocks and bonds, really stocks for the longest time through my 401k, through my IRA, years and years and years, tens and dozens of years before hearing about real estate. And even then, it was like the moguls, not necessarily Donald Trump, but like others in the market. So why haven't the general public, why aren't they aware of these types of alternative investments?
Yeah, it's a great question. And I will also say, just for those listening in, feel free to throw your questions in the chat or the Q&A, and we're happy to get to them. I'd say the big reason that we haven't heard about these investments, even though they're mostly great, but still have their risks, is a couple of reasons. One, the barrier to entry for these investments is high. Typically, investment minimums are $50,000. I've even seen some where it's millions of dollars, like the most exclusive opportunities. The average American, maybe even most Americans, I think 70%, are living paycheck to paycheck right now. So not many people are able to invest $50,000 every year, right? So if they don't even have the ability to do so, then they're not going to go out looking to tie up their capital for 5 years when they're living paycheck to paycheck. So it's a privileged niche world that we are lucky to be a part of. You, me, a lot of people listening to this live on the recording, it is a very privileged position to be in, to be able to even look at investments where you're tying up hundreds of thousands of dollars for years. Not many people have that. And like, if you're like most people, if your friends haven't done it, family hasn't done it, you probably haven't done it either or haven't heard of it, right? It's like they say, your network is your net worth. So if your network isn't talking about this, then you don't know about it. That's the easiest way to explain it. From a regulatory perspective, I'm pretty sure I'm getting these laws right, but Regulation D primarily governs how you can market these investments. Before 1982, Regulation D only allowed people to raise, I believe, up to $5 million for these types of investments. So a lot of times it was just institutional groups that were doing these investments, that were well capitalized, that didn't have to go and publicly raise capital through Regulation D. That's before 1982, when probably most of our parents were born on the call. So again, going back to, if our parents haven't heard of it, our friends haven't heard of it, we haven't heard of it. And that's why they haven't, because you could only raise 5 million. And even that had to be very select individuals. You couldn't publicly advertise. So then in 1982, the 506B exemption came along for Regulation D. 506B allows you to now raise as much capital as you want, but you have to only raise capital from people that you know and have an existing relationship with. You can't go around telling random people on the street, like, hey, Joe, come invest with me in my 100 apartments. You can't do that. That's illegal. You have to have a prior relationship with them. And even when you do, only 35 investors don't have to meet income or net worth requirements. Everyone else has to meet income and net worth requirements to be what's classified at what's called an accredited investor, which is one of three things. Either you alone earned over 200K on your last two tax returns, between your W-2, your investments, everything, etc. You and your spouse combined earned over 300K on your last two tax returns. Or lastly, not including your primary home, you're worth over $1 million. How many people do you think or meet those criteria and have 50K to invest every year? Still a very small pool of people. Then in 2013, part of the Jobs Act, the 506C, as in Charlie, comes along. Now that allows you to raise from anyone. Now you can go to Joe and say, hey, Joe, I don't know you, but you should invest with me in 100 apartments. But the catch is that he has to be an accredited investor and meet those net worth and income requirements. So we see that, one, the laws are very new in the grand scheme of things because our parents, definitely our grandparents, haven't heard of it. And two, most people can't even afford like $1,000 emergency if it hit them, because most people are living paycheck to paycheck. So how many people are going to pony up 50 grand for an investment that they won't see for 5 years? Right.
Right. So I would say like a lot of that might have went over the head of a lot of the audience. We'll get into like the asset classes that Clive Capital invests in, but how does someone invest in those alternative asset classes? Like, what's the best way to go about doing that without like relearning Reg D and 506B and 506C?
Yeah, there's a lot of nuance for sure as you get into this industry, and it really goes back to, if you want to get past these barriers, these reasons why you haven't invested in these syndications before into alternative assets passively, it really comes down to finding a fund manager that you trust, doing the due diligence to vet them so that you can trust them, right? Trust but verify. And at that point, usually what will happen is once you've vetted them, you've hopped on a few calls with them, they'll start sharing investment opportunities with you. And once the investor, the investor, see something you like John might say, hey, these 100 apartments interest me. Then we'll get on a call and I'll answer any questions he has. And if he still likes what he hears, then we move forward. If he doesn't, then he just waits until my next investment comes up. But if he does, at that point, you sign legal documents that our attorneys have prepared, SEC attorneys, Securities Exchange Commissions, same people who monitor the stock market, that hit Elon over the head for saying we're going $420 per share on Tesla. Once the legal documents have been signed, you can invest. And there's 3 ways to invest into these opportunities. And question that came in here at the right time, do we invest one time, or is this more of a recurring investment plan? Syndications, these passive private equity investments, are typically all upfront. We'll raise, say, $10 million to buy a 100-unit apartment building. Like, for more concrete numbers, we raised $34 million to buy 666 apartments a few months ago in Houston. We raised $34 million all up front from investors one time, and we used it to buy the apartments as a down payment, basically. Now, there are some situations, not to get too complicated, but I think these are always good things to know. There are some situations where you might have to contribute additional capital to keep the deal going. If it's an apartment building renovation, maybe the operator, the sponsor, the person who's running the deal, under budgeted. They said this is going to cost us 100 million. It's actually costing 110 million. In that case, a capital call will be made where they go out to existing investors and say, hey, we need more capital. In that scenario, you might have to invest again. But it's not like the stock market where you reinvest the dividends and all of that. It's usually upfront. and a one-time investment.
And there's another question that came in, but is a capital call a warning sign? Is it a scarlet letter on the fund manager because they maybe didn't raise enough?
It is a warning sign, but we can only control so much, right? So I think
Right.
it's all about upfront asking who you're investing with, what kind of risk mitigation guardrails that they put in place. If they put in 5 to 10 guardrails in place and you're still doing a capital call, then I would look at the broader market also, right? Like, is it because you're along the Gulf and a hurricane just came through? Is it because of rising insurance costs? Is it the macroeconomic environment in general where interest rates have gone up? Things like that. It really is a case by case basis. I would just say, and this is part of the education process, right? Where you look at different investment opportunities, find someone that you trust who can kind of guide you along this way of evaluating alternative assets, and that'll kind of teach you capital calls and things like that.
And we do have that in the due diligence checklist as well. Let's answer this question. Brendan asked, you mentioned a long time horizon on most alternative investment opportunities compared to the stock market because of the illiquidity and manual processes, building permits, contract signing, and so forth. What are some good examples of shorter term investments with still good risk adjusted returns? And then maybe we can talk about those asset classes, like what asset classes we focused on and why.
Yeah. I will finish up my thought from earlier about how to get into these investment opportunities.
Yes, that's right.
We left off at signing the documents and wiring your investment, submitting your investment. And there's 3 ways to invest. One is just cash, right? You have it sitting in a money market account or stocks, or just in your savings account. You wire that over, right, to the LLC. 2 is using retirement accounts. If you have a Roth IRA or a 401k from an old company, you can roll them over tax-free into what's called a self-directed IRA or an SD IRA. What that allows you to do is maintain a lot of the same tax deferral benefits that come from retirement accounts, but it allows you to not only invest in public markets, but also these private equity investment opportunities. It's a great way because usually a lot of people might not have a lot of liquid capital ready, but retirement accounts are illiquid. The point of them is to keep them locked up until you hit retirement age. So if it's going to be locked up, you probably know where I'm heading with this, but I would rather have my money locked up in an alternative asset like real estate or oil and gas than the stock market. Again, on that 666 units we bought a few months ago, for example, my parents invested 50,000 by converting a portion of their 401k over into a self-directed IRA and invested that way into the property. And the third way is the leverage. Most of you on the call probably have assets, you have homes, you have stock portfolios, things like that. You can take out a loan against that asset, right? A HELOC, for example. Let's say the loan charges you 8-10% a year. If we're doing our typical projected 20-25% a year on our returns, that's more than enough to pay for the 8% interest on your loan, right? So that's positive arbitrage. I would use that responsibly though. So, make sure you have some experience investing in private equity investments before you use leverage.
That's right.
At that point, once we have the capital from all the investors, your job as the passive investor is done. You don't have to worry about if a toilet broke. You don't have to worry about if an oil drill bit broke or there was an oil spill on one of our drilling facilities, anything like that. You're hands off. All of those headaches are on us, the fund manager, the sponsor, etc. And you're passive. And you will get monthly or quarterly updates about how your investment is going. And you'll get monthly or quarterly distributions from your investments also. And around this time of year, you'll get your tax form, Schedule K1, to file along with your taxes. And that's the goal, to every year invest in different opportunities and build this diversified portfolio. outside the stock market. So to Brendan's question about time horizons, most alternative investment opportunities, the time horizon is 3 to 7 years. The sponsor, the fund manager, whoever you're investing with, will let you know up front, hey, here's how long you should expect to have your money locked up. Now, some examples of shorter term investments are private debt funds. Usually I've found that these debt funds, they might issue anywhere between like 18 to 15% a year in just basic interest payments to you almost. And the liquidity for that could be anywhere between 3 months to a year, where you could sell out of your investment. Oil and gas, in my opinion, maybe energy in a broader sense, is a liquid investment because of the tax benefits. So in oil and gas, the investment I invested into, at least, again, not a CPA, every 100K invested, you save 30 to 40K. So if you invested, by the time your tax return comes around and you get it within a year, right, typically within a calendar year, you have effectively earned 30 to 40K, because instead of forking that over to the government, you're keeping that yourself. So there's a return of capital there. And with oil and gas, at least, the returns are front loaded. Meaning, typically, private debt is constant, right? It's a consistent rate of return because it's debt. You typically fixed rate. Real estate, on the other hand, is backloaded. Most of your returns come when you sell the property, right? Like if you think of flipping houses, for example, most of your profit's going to come on the flip. When we're doing apartment buildings or single family home construction, most of the profit comes on the back end when we sell. With oil and gas, the inverse is true. Your highest returns are usually going to come at the beginning, because that's the point where most of the oil and gas is still in the ground. So your returns will be really high within the first year. For example, I invested in November. I just got my first distribution a week ago, exactly, and I got 25% of my principal back in just one monthly check. And obviously it's going to decrease over time. Maybe next month it's 20% of my principal. But because you're making your returns a lot quicker and it's front loaded and you get the tax benefits, I would say that oil and gas is another good example of an investment with higher liquidity, because you're getting your capital back a lot quicker to recycle into new investment opportunities or use for living expenses, etc.
Got it. Okay. I definitely would encourage everyone to ask their questions. I have a few more questions, but if you have questions that you've always wanted to ask, now is the time. You can always reach Keshav afterwards. You can reach me as well to find out more information. And then also might be a good time to, if you, Keshav, you want to drop in your contact information, as well as that due diligence checklist. Those that are interested in alternative investments as well, find out more information on the investments that we talked about today. There's a 2-pager, really it's about 4 pages, that you can download as well. If you want to drop in the link, we can share that with people.
Could you make me co-host?
Yeah.
Okay. Because I can't message everyone at the moment.
Yeah. Any
so
questions? Go ahead.
Just for some context, John and I have put together, again, a 2-pager, and that is a quick 5-minute read about why you should be investing outside the stock market. There's data, statistics, from testimonials, high net worth clients, investment banks. Then that's a 5-minute read, because thanks to TikTok, we all have the attention span of a squirrel. And if you're still interested after that 5-minute read, you can download our ebook, which you can geek out a lot more on, because there's more data and more graphs and more rationale about investing inside the stock market. And lastly, you have the handy dandy due diligence checklist, 50 to 100 questions that we've referred to a few times, where these are the questions that you should be asking someone that you are looking at investing with into one of these alternative assets, whether it's real estate, energy, small businesses, whatever it is. And check that out. And I would say the best way to reach me is through LinkedIn, my name, or I could just throw in my LinkedIn. I put my email in there.
Another question came in. Recommendations on how to consider current interest rates when planning for loans to finance real estate or other alternative investments, asset investments.
Yes. This could apply towards the HELOC discussion or just with rates in general on the actual investment itself. I think in either situation, whether you're using leverage to finance your passive investment into the deal, or you're looking at it from the deal's perspective, where you're saying, hey, this 100-unit apartment building is using debt to buy the apartment building. This group is using debt to buy the apartment building. Always be responsible with leverage, right? And be conservative. If you're paying 8%, then make sure that your returns are doing at least, your investments are doing at least 10%, right? Or make sure that if the investment falls short, you have some cash on hand in your savings account or something, or you could sell out of some stocks to service the debt that you took on. So leverage is a great thing. I think financial leverage is what builds wealth. One of the best ways to build wealth. Let me see if there's anything else that I would say. I would also say don't make your decisions solely based on interest rates.
Yeah.
Don't hold your breath for rates to come down, because we just finished up probably a historical record low run of interest rates. People were paying 12, 13% interest in the 70s and 80s. So in the grand scheme of things, we have it pretty all right.
Right.
I did throw my LinkedIn in the chat as a quick aside. Back to the question.
For those people that are watching this as a recording, do you want to maybe spell out the URL?
Yeah. Well, it's linkedin.com/in/Keshav Kolur. You just search my name, you should be able to get it also. So
it's Keshav at clivecap.com. Yep.
Yeah, Keshav at clivecap.com. The curse of having a unique name is that no one can pronounce it. The blessing is that there's not that many of you, so it's pretty easy to find.
The alternative assets, if you go to clivecap.com/alternative-assets, you'll be able to see it there.
Yeah.
I can talk a little bit about HELOC because I am doing it. Now I got in and locked in a rate, 10-year rate when it was really low, like 3+ prime. So any investments just has to exceed 7-8%. So I make sure that I only look at things that are like 15+. So I can definitely talk to that.
Yeah. And yeah, I would say my guess is that rates are going to stay higher for longer to fight inflation.
Yep.
And that you shouldn't hold your breath to make investments. People are making investments right now because the returns look good. They're buying in at the right price, whether it's an apartment building, land where oil and gas is being drilled on, whatever it is. And they're being conservative. They have, again, 5 to 10 measures where they're saying, hey, all of these things have to go wrong before I'm in trouble. So that's what I would say. It is definitely a time to be more cautious because interest rates are higher. But if you're diligent and you're savvy, then and you're able to make returns in a high interest rate environment, that's what separates you as a good investor from others who can make good returns when the cost of capital is near zero. Like it doesn't take any skill or knowledge to do that. So if you're serious about becoming an investor, like now is a great time to practice evaluating investments when rates are so high. So
yeah. Yep. Any parting thoughts? I know we're getting to the top of the hour again. Any parting thoughts And any other additional questions from the audience. So parting thoughts first.
Yeah, I would say one, thank you for having me on, and thank you for taking the time to be here. And two, we'll be putting the links that we mentioned to the 2-pager read, the ebook read, and the due diligence checklist so that you can get educated about investing outside of the stock market. We'll be putting that in the description for this episode. And if you can't find it, just reach out to John or myself. I really wish someone had put this together for me when I was growing up, or my parents,
right. Yeah.
Or John for you and your parents. We'll put our LinkedIn or contact information in the description as well. And I would say the biggest thing is maybe two things. One, dare to be different. I talk to a lot of people where they haven't heard of this concept of investing into syndications, into private equity investments. And because they haven't heard of it, they automatically turn it off. I'm talking to investors all the time to raise capital for opportunities. And a lot of them will just say, hey, not interested. I don't want to learn about this, or this sounds fake. And I think you are just doing a disservice to yourself and those you love. Because while money's not everything, it affects a lot of important things in life: relationships, your health, your children's future, your hobbies, your free time, your freedom. So I would say take a chance, learn about it from someone, get educated. And then if you're not interested, which some people aren't interested, then that's totally fine. But don't knock it till you try it, as the old saying goes.
And also, there are studies on ultra high net worth, meaning $10 million net worth individuals or families.
30 million.
30 million, yeah, 30 million. And if you look at their portfolio and the allocations outside of traditional stocks and bonds, it's predominantly either in real estate or other type of private equity. So definitely look into that. We all aspire to that ultra high net worth, or even high net worth. Hey, I'm not going to knock that. So that's in the ebook if you're interested. I believe that's also in the 2-pager, that analysis. So download that, give it a read. It's really, really interesting.
Yeah, and then I would just say, second, one, don't be afraid to explore, and then two, just take action. Don't. A lot of people on the call, probably engineers, just because that's who John and I are. We work at tech companies, have worked at tech companies. Don't get caught up in analysis paralysis. Your mind can trick you into believing there's a million ways an investment can go wrong.
Right.
And there is, hypothetically, right? The stock market could also theoretically crash to zero at any given point. And so I would say mitigate your risks, but just be realistic about what your risks are. And there is no investment out there or anything out there that's really worth it in life. Relationships, health, finances, that doesn't come without risk. So
no. Okay, with that, I think we are done with this particular session. Thank you very much for your time, Keshav, as usual. And thank you for being generous with your time. We are going to post this on the various channels. Go to our website, clivecap.com, just to find out more information, as well as to see this recap. It'll be posted there. It is also posted as a podcast. If you haven't explored podcasts before, go to your favorite podcast and look for Investing for Generational Wealth. All of our webinars are reposted as podcasts. And with that, I'd love to thank you, everyone, for attending. Don't forget to subscribe to the podcast when you are there, or whichever platform you're listening to, and make sure to like us, and we'll continue bringing you the best educational content. Thanks, everyone. Until next time, keep learning to invest for generational wealth. Thanks.